Welcome back to The Explainer. So today, we're diving into a seriously high-stakes reality that's playing out right now across the global financial system. You see, Wall Street's absolute favorite trade, this massive, seemingly unstoppable artificial intelligence boom, well, it's suddenly turned into its absolute biggest fear. The exact same AI stocks that were single-handedly pushing markets to dizzying record highs just, a few weeks ago, yeah, they're in free fall. We're witnessing a major shift in real time. So today, we're going to use the data to break down exactly what's happening, why it's happening right now, and most importantly, what this all means for the broader economy.
Okay, let's dive into this minus 11%. We have to start with the sheer scale of the damage here. The Nasdaq 100, which, if you don't know, is the index heavily packed with all the major tech and AI names, has plummeted 11% from its June record high. Make no mistake, that is not just a minor dip or your regular Tuesday in the markets. We have officially entered bubble correction territory. The momentum has violently shifted in reverse, and investors are basically scrambling to figure out where the bottom actually is.
Section 1. The AI market crash. This was the first domino to fall.
To really understand this crash, we have to look at exactly where the core of this financial pain is concentrated. And right now, it is intensely focused on the chip-making sector. Major U.S. semiconductor companies, think Micron, AMD, Marvell, they were hit first, and man, they were hit the hardest. I mean, for the last 2 years, these companies have been absolutely printing money as tech giants race to build out their AI infrastructure. But suddenly, investors are genuinely fearing a slowdown in AI spending. The exact moment the market even suspected that tech companies might, pump the brakes on buying massive amounts of hardware, these stocks were aggressively sold off on Wall Street.
And this brilliantly illustrates how interconnected the global tech economy really is. Because this crash, it wasn't just a localized U.S. problem. The panic spread overnight across the major Asian markets. Just look at these drops. South Korea's SK Hynix plunged more than 11% in a single trading session. Japan's major chip equipment maker Tokyo Electron slid over 10%. And even a massive conglomerate like Samsung fell by over 9%. The shockwave traveled across the Pacific in a matter of hours, literally wiping out billions in market value.
Now, you might be wondering, why chip makers specifically? Like, why are they the ones taking the biggest beating? Well, it all comes down to what we call a picks and shovels play. Think back to the California gold rush. The people who consistently made the most money weren't always the miners. They were the people selling the picks and shovels. In the great AI gold rush of the 2020s, semiconductors are those foundational tools. They're the essential hardware required to participate in the boom. And because they're sitting at the very base of the supply chain, if the AI hype cools even a little bit, chipmakers are the absolute first assets investors dump. Section 2. The Fed adds fuel. The second falling domino. Because right as the stock market was showing its extreme vulnerability, it collided head-on with a highly turbulent meeting at the Federal Reserve. Here's exactly what went down. Trump's newly installed Federal Reserve Chair, Kevin Warsh, held interest rates entirely steady at a range of 3.5 to 3.75%. Now, on the surface, keeping rates steady isn't inherently shocking, right? Markets often expect pauses. But it's not just about the final number. It's about how they arrived at that decision, and that is where things get really fascinating. Behind closed doors, and eventually out in the open, there was significant conflict. 3 members of the Fed's own policy committee formally dissented against the decision, flat out stating they wanted to raise rates instead. What's incredibly rare here is seeing this kind of public disagreement inside the Federal Reserve. Usually they strive to present a unified front to keep markets calm. So this level of visible internal division strongly signals that the people steering the American economy are deeply conflicted over whether inflation is actually under control. To compound the issue, Chair Warsh talked very tough about fighting inflation during the meeting, but ultimately didn't lay out a clear plan of action or raise rates. A veteran Wall Street strategist summed it up perfectly with this quote: "Talking tough without acting reduces the Fed's credibility." And yeah, this combination of hawkish talk with zero actual action didn't reassure anybody. Actually, it made markets incredibly nervous. Investors hate uncertainty above all else. An central bank that appears divided and hesitant, that creates a massive amount of it. The market's response to this Fed meeting was swift and honestly staggering. Bond yields spiked dramatically. Specifically, the 30-year Treasury yield hit its highest level since 2007. Just let that sink in for a second. 2007. The last time we saw yields jump to this level was right before the great financial crisis. When long-term borrowing costs spike like this, it acts like a giant anchor dropped directly on the economy. But let's bring this out of the abstract world of bond yields and directly into your wallet. Like, why does a 2007 level Treasury yield matter to you? Well, because it makes borrowing money significantly more expensive across the board. It means more expensive mortgages if you're trying to buy a house. It means costlier business loans, which stifles company growth and hiring. And it means higher government debt costs, which eventually trickles down to taxpayers. The Fed's attempt to navigate the situation basically ended up severely tightening financial conditions for everyday people.
Section 3. Wall Street versus Main Street, the economic disconnect. We need to understand why this matters far beyond just the tech stocks in a brokerage account. Now, what's really interesting about this slide is the sharp, undeniable contrast it reveals between two completely different Americas. On one hand, you have Wall Street. For months, they've been absolutely partying on AI hype, pouring billions into data centers and tech infrastructure. But on Main Street, regular consumers are getting squeezed tight. Gasoline prices have crept back up above $4 a gallon, partly due to geopolitical tensions in the Middle East pushing oil prices higher, and those wage gains that briefly outpaced inflation earlier this year, they're widely expected to fade. So you have this massive wealth generation on paper in the tech sector, while everyday people quietly absorb higher costs in their daily lives. And here's a critical piece of data that most people are completely missing. If you strip away all the massive investments going into AI data centers and chips, a huge chunk of America's broader economic growth story is actually faltering. Non-AI business spending has been remarkably weak. This means our economic growth has become dangerously concentrated. The broader traditional economy isn't booming. It's just being masked by the blinding light of the AI gold rush. Section 4. Is the bubble popping? Where does this all end? So with all these dominoes falling, the chip crash, the divided Fed, the strained consumer, we have to ask, is this the bubble popping? Are we looking at the start of a total economic collapse? Well, the data suggests not necessarily. We've got to keep some perspective here. Despite the sharp tech drop, the broader S&P 500 index is still within just a few percentage points of its all-time record highs. What we're witnessing right now looks a lot more like a very serious correction and a repricing of fears, rather than the entire floor falling out of the market. It's a massive wake-up call, sure, but maybe not the apocalypse just yet. However, the warning signs are absolutely real, and they are flashing bright red. Let's summarize the 4 undeniable pressures driving current market fears. 1. A divided Federal Reserve struggling with credibility. 2. Rising long-term bond yields that choke off borrowing. 3. Fundamentally weak non-AI business investment. And 4. Mounting skepticism about whether all this massive AI spending will actually generate the profits investors are hoping for. These are 4 incredibly heavy weights pulling down on the market right now. So the crucial point is this: we are about to get our answer. The upcoming corporate earnings reports are the ultimate stress test. We're waiting on massive names like Microsoft and Meta to report their numbers. If these tech giants disappoint, like if they reveal that AI isn't generating the revenue they promised, this correction could deepen into something much uglier, very fast. But on the flip side, if they beat expectations, this whole panic could just turn out to be a temporary scare. The entire market is basically holding its breath for these earnings. That leaves us with one final, absolutely vital question to consider. What happens to your 401k and your mortgage if this AI correction actually turns into a full-blown crash? Because the ripples of a true tech collapse would affect almost every single aspect of personal finance. We are out of time for today's explainer, but if you want to understand exactly how to navigate your personal wealth through that potential storm, hit the subscribe button right now. In our next explainer, I'll be breaking down those exact personal finance impacts step by step so you can be prepared for whatever the market does next. Thanks so much for learning with me today, and I'll see you in the next one.